Top down, the biggest potential source of a fuss in the week ahead is the latest meeting of the oil cartel OPEC's members. That will take place in Vienna on Thursday the 5th and Friday the 6th of December. Now in 2016, OPEC surprised a lot of investors by agreeing to cut its output by 1.2 million barrels of oil a day to around 32.5 million. Saudi Arabia led the way, but non-OPEC members, spearheaded by Russia, joined in, as they trimmed output by around 0.6 million barrels a day in an attempt to support the price. That seemed to work. Oil rallied from barely $30 a barrel to around 80, using Brent crude as a benchmark, and as the price rose, OPEC increased output, but in December 2018, the cartel was on the back foot again. Concerned by talk of a slowing world economy and also rising US output, OPEC cut production by 800,000 barrels a day, and it then stuck to that cut at April's meeting in Vienna. Now, total OPEC output averaged around 29.5 million barrels a day in the third quarter of this year, and, according to OPEC data, Saudi Arabia swallowed pretty much all of the cut on its own, reducing output to around 9.5 million barrels a day in the third quarter of this year. The net result, based on OPEC's latest monthly report, is that global oil output is running at 98.3 million and demand at 100.7 million barrels a day. In theory, there's a supply shortfall. That could be helping crude a little bit, but it's not making a fat amount of progress either, judging by the European Brent and American West Texas Intermediate benchmarks. This chart covers the last 5 years, by the way. Now, why is oil maybe not progressing more? Well, there are several possible reasons. The market knows that Saudi Arabia is holding back. The market knows that American sanctions are keeping Iranian supply, for example, out of the market, and that's waiting to come back. And also the market knows that US output continues to surge thanks to shale. Now, of course, that said, if Democratic Senator Elizabeth Warren wins the 2020 presidential election, she said she'll ban fracking altogether. So there's always potential for something to come out of left field, and that is before we assess the risk of geopolitical or military upset in the Middle East. So when it comes to assessing the news from Vienna on the 6th, the 3 things to look for in the communique are comments on production relative to that 0.8 million barrel a day cut and overall OPEC output, which again is running at just under 30 million barrels a day. Any comments on the timeline for any production targets, as the current cut only runs till January, and any pointers on the intentions of non-OPEC members, particularly Russia, which has generally been supportive of output discipline in the past. Why does all of this matter, even if you've no exposure to oil stocks at all in your portfolio? 2 possible reasons. 1, if you have exposure to UK equities through a fund, and especially a tracker fund or ETF, you probably will have oil exposure. Oil stocks are forecast by analysts to generate 17% of the FTSE 100's total profits in 2020 and 1/5 of its dividends. Secondly, history shows that if oil jumps by more than 50% year on year, the global economy tends to slow. And if oil doubles, a recession is rarely far away because of the hit to consumer spending power and companies' cost bases. The good news is that oil's basically flat on where it was a year ago, and it would need to get to $95 a barrel to rise 50% and $125 to double, compared to the current level of around $63 a barrel for Brent. Now, back on the home front, only a handful of FTSE 100 firms are due to update investors this week, although a selection of mid and small cap companies are due to release interim or full year results, publish a trading statement, or host an analysts or annual general meeting for investors. Names to note include silver miner Fresnillo on Monday the 2nd of December, plumbers merchant Ferguson, Wizz Air and Cineworld on the 3rd, Just Eat on the 4th, DS Smith and specialty chemicals firm Victrex on the 5th, while Whitbread and Associated British Foods will both be hosting their annual general meetings on Friday the 6th of December. But the biggest potential source of a fuss on the corporate front in the week ahead could just come in the form of interim results due from FTSE 100 member and high-end house builder Berkeley. They're due on Friday the 6th of December. Now, as you can see here, the shares have done very well indeed over the past 12 months, despite concerns over the UK economy, Brexit and the general election, to name but 3. Barclays' extension of its cash return programme to 2025 may be one reason why, more of that in a moment, as may upside earnings surprises relative to guidance and management's target of a long-term pre-tax return on equity of around 15%. So, When it comes to the first half numbers, there'll be 5 things to watch for. First, the trend in reservations and whether there's been any stabilisation here. This will also be reflected in the forward order book, which came in at £1.8 billion at the end of the last fiscal year, down from 2.2 the year before. Second, look at the trend in pricing. In its last full financial year, Berkeley's average selling price was £748,000, up from £725,000. This next graphic shows how Berkeley's average annual selling price has developed since the Great Financial Crisis, as well as completion volumes. Third, look at earnings. Berkeley is currently running ahead of its target of £3 billion in pre-tax profit between 2016 and 2021, even though management's guided to a 1/3 drop in profits for the full year to April 2020. Consensus is currently looking for £536 million for the whole year, down from 775, so that 30% drop, well, that's probably roughly your benchmark for the first half too. Fourth, look at cash returns. By the end of the last fiscal year, Berkeley had returned £12.34 a share to shareholders as part of its plan to return £16.34p by 2021. That leaves £400 a share over the next 2 years, a run rate of around £280 million, and that's been extended to 2025. Watch out for comments on the mix between dividends and share buybacks too, which last year was 20% dividends, 80% buybacks. And fifthly and finally, net asset value or net NAV per share will come into focus. That was £23.05 at the full year stage. This last chart shows how the NAV again has developed on an annual basis since the Great Financial Crisis. Now, Berkeley shares do still trade at a premium to that, and quite a big one, despite the questions over current trading. I guess that's helped by the still decent backlog, the company's high-end positioning, and that cash return plan. £280 million a year out to 2025 is 6 more years of that, or £1.7 billion, nearly 30% of the current market cap. Thank you for watching, and I look forward to seeing you next time.